So in Chapter 8 of Investing for Dummies by Eric Tyson, he goes into how to assess mutual funds. A mutual fund, if you're not aware, is simply a big pool of money from which a lot of typical investments are managed by a mutual fund manager. He talks about how a lot of these funds have sneaky loads built into them, even though they're told they're not no load. Although even though he says there's a lot of unscrupulous behavior with mutual funds, professional management is worth the cost. What is the cost? Generally between about a 0.5% to about a 1% to as high as about 2% on some of the funds that he claims, and I agree with him, are really sold as a lot of hot air. In fact, he goes into it later in Chapter 8. He explains that a lot of the funds that charge extremely high fees are actually performing the worst, and this is because they go out of their way to try to prove they can beat the market, and they end up having to play a lot of games like returning principal, etc., and in some cases just committing outright fraud. One of the benefits of a mutual fund is you have generally automatic diversification. Stock funds not so much, but most mutual funds aren't invested primarily in stocks. The idea is that if you're just letting someone else manage it and they're able to just make that their full-time job, they can provide a lot better returns than you would on your own, picking your own stocks, which is generally true. Eric Tyson is correct about that. Reasonable investment minimums, basically they're not going to generally work with you unless you're putting in at least $500 or a schedule of $50 a month. Bond funds, if you need current income, that's the place to go. Money market funds is when you want to not avoid declines in value at all, and stock funds are generally the most aggressive. The financial safety of a mutual fund is generally better than individual stocks. He talks about the keys to the successful fund investing is that you want to minimize cost and also just avoid grift. At the end of the day, if you take performance versus risk, he really comes down with index funds, and he even mentions some very specific mutual funds that he thinks highly of. Overall, he says it's about allocating for the long term. You shouldn't expect to have a home run of a year necessarily. It's about having a healthy return over time. Short-term bond funds are the least sensitive to interest rate fluctuation. So if you're in chaotic times, that might be one of the best places to be. He talks about the best money market funds, and mind you, this came out in 2008, is Artisan funds, Dodge and Cox funds, Fair Home funds, Fidelity funds, although he does give some harsh criticism of Fidelity as well, TIAA CREF, and USAA funds. Ultimately, he says that the USAA tax-exempt money market fund is great if you have high tax liability and if you're looking for something that's consistently safe. He actually comes out and says that there's some great ETFs for owning precious metals, but that owning precious metals itself isn't a good idea. I would have agreed with him in 2008 when this came out, but right now, given the chaotic state of the world, owning bullion might make a hell of a lot of sense, as it has in prior generations when things were collapsing.